Did you know that the gold standard, which once held the global economy together, only allowed currencies to be stable as long as gold was in the picture? Imagine a world where money was backed by a shiny metal. But what happens when that stability is thrown out the window? Let's dive into the story of how the gold standard met its demise. Alright, folks. Today, we're talking about the Bretton Woods Agreement, a big deal in economic history that shaped the post-World War II world. You see, after the war, countries were looking for a way to stabilize their economies and prevent the kind of chaos that led to the Great Depression. So, in 1944, leaders from 44 nations gathered in Bretton Woods, New Hampshire, and created a new international monetary system. This agreement established fixed exchange rates, with the US dollar pegged to gold, and other currencies pegged to the dollar. It was a bold step towards global financial stability, but as we'll see, it wasn't without its challenges. Now, let's get into the nitty-gritty. As the years rolled on, the Bretton Woods system started showing some cracks. Nations faced inflation, trade imbalances began to surface, and the US dollar was under tremendous pressure. Countries were accumulating more dollars than they had gold reserves to back them up. This created a lack of confidence among foreign governments. They started to question if the US could keep up with its promise to convert dollars into gold. As the dollar weakened, so did the stability of the whole system. It was like a game of Jenga. One wrong move, and the whole thing could come crashing down. Leaders were starting to feel the heat, and the pressures of the global economy were mounting. Fast forward to the late 1960s and early 70s, and we see the tension reach its peak. The Vietnam War was draining US resources, and inflation was creeping in. The US was faced with a dilemma: keep pouring money into the war or stabilize the dollar. The world was watching closely, and countries like France and Germany began exchanging their dollars for gold, draining the US gold reserves. In a desperate attempt to keep the system afloat, the US made some key decisions that would ultimately lead to its collapse. In 1971, President Nixon and his economic team took a hard look at the situation. They realized that maintaining the fixed exchange rates was becoming impossible. With trade imbalances widening and countries looking for ways to protect themselves, the pressure was on. Nixon's administration began making moves that would shake the very foundation of the Bretton Woods system. They implemented wage and price controls and even suspended the dollar's convertibility to gold temporarily. The world was on edge, and the economic landscape was shifting dramatically. Then came the moment that changed everything. On August 15, 1971, President Nixon announced to the world that the US would suspend the convertibility of the dollar into gold. This marked the end of the gold standard as we knew it. It was a bold and controversial decision, and it sent shockwaves through financial markets everywhere. Suddenly, the world was faced with a new reality: floating exchange rates. Countries could no longer rely on a fixed system. They were now at the mercy of market forces. This moment was pivotal, leading to the complete disintegration of the Bretton Woods framework and paving the way for the modern monetary systems we have today. So, what does all this mean? The collapse of the Bretton Woods system had significant implications for the global economy. The transition to floating exchange rates allowed currencies to fluctuate based on supply and demand, leading to more volatility in the markets. While this flexibility has its benefits, it also brought about challenges like currency crises and economic instability in some regions. The end of the gold standard represented a shift towards a new era in finance, one where central banks and monetary policies play a crucial role in managing economies.